Do mortgage rates impact fix and flipping? Are higher mortgage rates a good reason to sit out of real estate investing? Let's talk about it. Let's have a little history lesson before we get into this. You see, mortgage rates has been as high as 18 to 20% in the past. And yes, people were still buying and selling properties during that time, although it was very difficult. One of the reasons that this was difficult is they went from about 7% to 18% in about the 1980s, and they did that over the period of about 1 year. The problem with that is it decreased the buying power of somebody that was actually purchasing a house. So does it affect fix and flips? Well, what it affects is buyers who are able to purchase properties. Now, there are always buyers regardless of interest rates, but your buyer's pool is going to go down considerably as interest rates go up. Let's talk about this real quick. If you take a look at this graph, you're going to see interest rates over time. This is a 30-year fixed rate mortgage over time. And so you'll see in, I don't know, what is this, 1970s, the interest rate was at around 1%. From the 70s to the 80s, it went from 8% to 16%, so it almost doubled. Then the interest rate came down again, and then it shot up one more time before it started to stabilize and what I would call more of a normal level as to what we're seeing right here. Now, what you'll see with all of these is there's reasons for this. You can see interest rates were about 4.5%, and then COVID hit. So what did the Federal Reserve do? Is they lowered the interest rate. Now, let's talk for a minute about the Federal Reserve. The Federal Reserve is the interest rate you're hearing about. Did the Feds raise rates? Did the Fed raise rates? What they're basically talking about is the Federal Reserve rate, which is what banks borrow against each other and against the Federal Reserve. So what that means is if the federal interest rate is at 3%, that's the amount that a bank like Chase or a credit union or financial institutions are borrowing it against the Federal Reserve at, which means they're basically borrowing at 3%. Now you're going to say, well, why am I paying 6%? The reason is that's how banks make money. They borrow at 3% and they sell at 6%. And that additional 3% they put on there is called a margin. That margin is how they make money in addition to fees and everything else that they're going to be charging you to make a loan actually happen. But what that does is sets it in so they're able to make a margin when they borrow against the Federal Reserve. Now, you're going to say, well, why does the Federal Reserve screw around with interest rates? Well, the reason is they are trying to control the economy. And I'm not saying this is the right thing or this is the wrong thing in any way. I'm just saying this is the way that it is. So as we've seen over the last couple of years, we've been seeing house prices grow astronomically. We've seen house prices go up 10, 20% year over year, and that has led to a problem of home ownership and having the real estate market just getting a little bit out of control according to the Federal Reserve. Let's talk about this just for a minute. Okay, let's say it's 2022. I'm gonna get a better marker, you guys. I'm not liking this one. Okay, it's 2022. Let's say 2021. So they say 2020, and let's say 2019. Okay, this is a graph that shows the median house price over time. So you can see the median house price back in 1965 was $20,000, and we're looking about $440,000 right now. Okay, so basically though, let's look year over year. This is 320. And if we come over to 2015, it's going to be 489. So you're seeing you see it go up, you see it come down, and you see it come up again. So if we go from like a 430 in 2022, I'm going to write that on our whiteboard, 430, and we come back to... Okay, so what we've basically seen is we have seen these property values go up by $117,000 over a 1, 2, 3 year period. We're starting 2022 right now. So if I divide that out by 3 over 3 years, now you can make fun of my math, but I want to introduce the principle. It's not going to be perfect, but it's going to give you the idea. So you're basically $39,000 increase a year if we're just averaging it, okay? And 39 divided by 313 is about a 12% increase. So what we've seen is about a 10 to 12% increase every year over the last 3 years, okay? So what's happening is the Federal Reserve is saying, we have a problem here. And the reason why they're saying that we have a problem is because values are going too high too fast. So what do? They have a lever which is called interest rates, and they pull that lever to increase interest rates. Now, I will also tell you, when there is times where there's economic uncertainty, like COVID, they press the lever down to try and encouraging borrowing. So the concept here is the Federal Reserve is trying to manipulate the marketplace and saying, we know what's best. I'm not saying this is right or wrong, but if there's economic hardship, they're lowering interest rates. If there's economic prosperity, they're raising interest rates to try and find some sort of an equilibrium. Now, how does this affect our fix and flips? Well, let's just say that I was going to go and get the house for $313,000. And at that time, let's say the interest rates were 4%. So that just means, this is without taxes and insurance, this is just PI, principal and interest is basically what we're looking at. So a $313,000 house at a 4% interest rate would have cost me, let's just call it $1,500 a month. Okay, but that same house the next year goes up to 300, let's just call it 350. So you get an idea. So that goes up, and now your payment is $1,671. Well, guess what? It goes up again. So now you're saying, hey, this house is now worth $430,000. And at that same 4% interest rate, your payment is now $2,053. So your payment has gone up about 30% from where it was originally for the exact same house. Well, this is problematic for people. But if you add to that one more element, which is interest rates actually rise, guess what? Let's change this to a 6.5% rate. And well, that's fine. Let's go 6.525. You're talking about $27.97 in a payment at a 6.5% rate. Let's jump over the whiteboard here. So look what's just happened, guys. This same house that somebody bought and is paying $1,500 a month, right now somebody would be buying and paying $27.97 a month, close to double, about 80% more than what this guy bought the house for. Well, the problem with that is there's not unlimited funds for families. There's so much funds, and that is going to deter or bring property prices down because it's a lot more expensive to buy this than it was before. Now, it's important that you realize this was done by design by the Federal Reserve to try and cool off the housing market. The other thing you've got to realize is that if it cools off too much, they're going to lower interest rates in the Federal Reserve, so they will encourage borrowing, so people will start buying again, which means you're going to see prices start to stabilize, or you'll actually see prices to increase. Now, what should you be doing in today's market if this is our reality? One thing you've got to think about here is as values start to come down, as it starts to become a buyer's market rather than a seller's market, something you need to realize is if you can cash flow at current interest rates on a rental type property, you're going to be in great shape long term. Let me show you what I mean by this. So if current interest rates are 6.5%, or let's say they're going to go to 7%, let's talk about this. That is going to have an impact on property values. Let's say interest rates are, let's just say they're 7.5%, okay? 7.5%. 7.5% is our interest rates. Let's just say that's where it's at. And let's just say our average loan is, let's just say $250,000. Now, your area might be a lot higher, it might be a lot lower. I'm just teaching a principle here. So at 7.5, your payment on that would be $1,748, okay? Now, part of that is gonna pay down your amortization schedule and that type of stuff. That's gonna happen. So if you can buy a property that's in bad condition, you get a hard money loan to do the purchase and the rehab. So let's say you end up buying this property for, let's say you buy it for $200,000, you put $50,000 into it, and you're into a $250,000, just for number's sake. Yes, there's other costs in here, agents, not agent fees because we're not selling it, but you're gonna have some property taxes and some maintenance and that type of stuff. But let's just go with this $250,000. Okay, now at that $250,000 at a 7.5% interest rate, your payment is going to be your payment's going to be $1,748 on this $250,000. Okay, so the deal here is hopefully this property's worth a little bit more than what you bought it for. Maybe 300, maybe 275. Okay, hopefully you've created some value by doing what's called value add. In addition to that, if you can pay your payment, your taxes, your insurance, and all that type of stuff for what the rent is. Let's say the rent's $2,000, and that pays your payment, and it pays taxes, and it pays insurance. And so you're basically breaking even right now. Okay, you're breaking even. Maybe you get $2,200 and you're only making $200. Okay, that would be a good deal right now, because as the market starts to come down, I'm buying a better property, I'm improving that property, I'm putting that on rents. We know rents go up over time. And in addition to that, we know that at some point interest rates are going to come down. Now, what people are going to start trying to sell you is they're going to try and sell you adjustable rate mortgages. They're going to say, hey, if you do this, we'll get a lower interest rate, and they'll start with this and start with that. Don't do it. You want a 30-year fixed mortgage, because the other thing we know is as things start to slow down, and they keep slowing down, the Federal Reserve is going to crank that button back, and they're going to start lowering interest rates. So that $250,000 you'll probably owe, let's say you owe $225,000 here in a few months, and let's say interest rates go down to 5%. That would take your payment down to $1,200, which means you would make $750 a month if you're making zero, and $950 a month by simply having the interest rate go from a 7.5% to a 5%. Why am I saying all this? Well, there's always an opportunity in real estate investing, always an opportunity. It's your job to find it. As interest rates are starting to go up, now's the time to start negotiating hard on properties, trying to get the very best deal. It's changing from a seller's market to a buyer's market. That is not a bad thing. It's actually a great thing. Now, if you can use a BRRRR type strategy where you buy, you renovate, you rent, and you refinance the properties, you will be getting into a great opportunity here, because you're locking down a low price on the property. You are improving or value adding to the property to make it worth more than what you actually paid for it because of those improvements that you've done. You're also locking in a 30-year fixed rate, which hopefully you're breaking even or at least making $100. I wouldn't go negative cash flow, but I would probably want to make sure I was prepared for rents to go down 5 to 10%. So I would want to make sure in a deal like this, I had like $2,200 in rent, because if rents go down to $2,000, I'm then breaking even, paying my taxes and my insurance. Now, keep in mind, every single month that I get that payment, it is also paying down part of the mortgage, so my mortgage balance is actually going down as well. Then when the market starts to change even more and come down even more, I am then going to refinance that property into a lower fixed rate 5-year, and I create my market spread and my rent spread, and then I'm going to keep that property forever. Now, what are some of the downfalls of this? Well, you're going to have to manage properties, and most people don't know how to manage properties well. Some of your biggest expenses are going to be putting the wrong tenant in. If you put the wrong tenant in, it will cost you 10 times the amount that it does in lost rents. I would rather have a property vacant for years than I would put the wrong tenant in there. But I don't have properties vacant for years, and the reason for that is I rent under what the market is. If the market rates are going to be $1,000, I'm going to rent for my property between $900 and $950. Well, why do I do that? Because I want to get the very best tenants. Everybody comes to me. I select the very best tenants because everybody wants a good deal, especially people that are great and take care of properties. And then I have people stay in the property longer. So rather than having people stay in the property for 6 months or a year, I have people staying in the property for 5 years. I've even had people stay in the property 10 years. And I think my longest tenant right now is 15 years. Think about that. They more than paid for half of my property through paying rent, and I cash flowed along the way, okay? So that's what we're talking about here. You've got to find the right tenants. You've got to under rent the property. You've got to manage that property appropriately. Now, are there going to be some costs? Yes, you are going to have some things you're going to have to fix up. There's fix up costs, and then there's capital improvements. Now, if you've gone through the BRRRR strategy, you've done all this renovation, you shouldn't have a lot of capital improvements. Those should have already been done, and those should have been done with your hard money lenders funds and the purchase as well, so you're not coming out with a lot out of pocket. Then you're just going to have things like if something breaks that needs to get taken care of. So you are going to need some money to take care of those things. They are going to come up from time to time. You are going to have some vacancy from time to time unless you do it right. And with that, you need to have a little bit of reserves so you can hold out through this time period. The other thing you want to do is keep buying properties. If values keep going down, you want to keep buying properties, because values keep going down, you keep buying properties, you keep doing the BRRRR strategy, you lock in an interest rate, and then when you see interest rates go down, you refinance everything, and then you're seeing your cash flow increase drastically. I don't see another opportunity like this. Hasn't been around in quite some time because of how hot the real estate market has been. So now is the time to find the opportunities. Now is the time to negotiate hard, make a great relationship with a hard money lender, and you are going to want to make sure that you are prepared to do those takeout finances and wait for interest rates to come down at some point and refinance. All right, if you would like my exact process for calculating after repaired values in a really fast manner, you're gonna wanna check this video out. It will help you be fast and accurate. After repaired values is really important as we're dealing with the market that we're currently in. We also talk about how to throw out bad deals faster and move on to good ones, and my rule of thumb on how to use the very best comps. Check out this video and make it a very profitable day.